probably shouldn't say this, but don't take venture money. I wouldn't recommend that. Try to bootstrap your company as far as you can go.
Ultimately, ideas are dime in a dozen, right? There's so many ideas out there. It's execution, and I think more so resilience, right? Like you get beaten down, you just do it again. You get beaten down, you do it again.
What is traction?
We want to see paying customers that aren't your roommates, your family, your friends.
The cost of starting a business has gone drastically down.
I somewhat disagreed.
How should a founder think about who to listen to and who to not listen to?
Even the right people can give you bad advice.
Hey everyone, super excited to have you back, VC Unfiltered, for another episode. We had demo day back in the middle of October with all of our portfolio companies, but in tandem with that, we'd like to keep the education piece going, and so we ended up running 2 VC panels at the exact same time on both ends of it. Here is one of those panels with our principal, Griffin, and a bunch of incredible guests.
To start off, I'd love for everyone just to give kind of an introduction on yourself and your firm, as well as maybe how you came to be the seat you are, or some background that led you into VC.
Awesome. I'll start off. Marshall Smith, general partner and co-founder of Steamwork Ventures. We invest in mature seed to Series A, B2B, and B2C SaaS with higher probability outcomes. Happy to get into that later. We wrapped up Fund 1 earlier this summer, which was all around health, wealth, and sustainability, still focused on software. Not afraid of product, but very low capital intensive product. Never thought I'd get into venture. My background is in wealth management. So started off traditional finance, managing core ETF strategies for high net worths, financial planning, retirement planning. Loved the building of businesses and the management, so became the COO of an RIA here in Los Angeles and helped them scale from managing $250 million to about $1.3 billion in 5 years. And as COO, really oversaw all aspects of the business, from asset allocation to HR, compliance. Been through many SEC audits, operations, HR, you name it, was involved with it. Saw really a need as we were hiring and building, and launched a fractional COO business. And so I was setting up wealth management firms for breakaway advisors, those leaving the big wirehouses, the big banks. Could come in, again, completely turnkey. It takes a couple months to negotiate your way out at some of these large firms, so could build the complete RIA for them. As soon as they were ready, flip the switch, transfer over clients, and move on. That led to working more and more with just startups on the operational side of things. Again, love building businesses, love getting my hands dirty. So I was getting introduced to more and more startups. Again, founders could focus on raising capital and product, and I could focus on the back office, processes, repeatable processes, procedures, and so forth. And that led to meeting my current partner, who is a serial entrepreneur with multiple exits, and we just loved working together. We were consulting, we were doing angel investing, obviously my background in wealth management, and we just wanted to expose more and more people to venture and help founders. As entrepreneurs, operators, and executives, we've done it through every business cycle possible over the past 2 decades. And again, just love working with founders and building business.
And then as far as kind of stage that you guys are investing in right now?
So we're what we call mature seed to Series A. We look for, obviously, companies that are in revenue, that have a client base, not just friends, family, and so forth. We really want to help accelerate that growth. They're typically 12 to 18 months from a Series A. We use our background as entrepreneurs, operators to really help accelerate that growth. Not just come in with capital, but come in with our network, trusted third parties, advisors, corporate connections, and so forth.
Awesome.
Thank you for having me, by the way. And also thank you to the founders. You all did a great job here. So I'm Blake Caldwell, CEO of FoundersBoost, also FoundersBoost Fund. We invest in early stage, pre-seed stage companies. We have a pre-accelerator. It's a lean pre-seed stage accelerator. We have an alumnus here tonight. I'll comment on it in a bit. But I've always been driven by a passion, or I guess the last decade, of helping early stage founders get to their destination without taking equity, without charging, figure out ways to help them get farther with the resources that they need. And we built FoundersBoost with an accelerator. We're in 20 different regions globally. We essentially have been able to scale this out, and which has driven a pretty large deal flow that allows us to not only provide the support with our kind of nonprofit model, but now also have access to fantastic founders who essentially have, I guess I'd like to call it a reverse accelerator model, where we can now come in and invest in these companies, having seen them. I'm sure there's some questions kind of go into what we like about these types of founders, but that's our base model. I'm driven by the passion of helping founders. I go back to, I guess I'll at least mention Johns Hopkins. I think there was something here. This is my background in computer engineering, biomedical engineering, and I've always had a diverse set of passions. Went into software engineering and ended up doing consulting and started working in the lean startup methodology, and fell in love with that over a decade ago. And from there, I haven't looked back. Worked with an organization called Up Global, which you may know as Startup Weekend. It's kind of hackathons for business, figuring out how to help that early stage founder and that team get to that next stage, which was a pretty big gap from a hackathon weekend all the way to accelerators and to VCs. And so we developed a pre-accelerator. Obviously, we're in pre-accelerator here. We were one of the earlier adopters of that name. But really kind of figuring out how to be that gap in the ecosystem. And from there, we've been a part of Techstars and eventually launched FoundersBoost, and been doing that now for 7 years. Absolutely love it. We have been kind of adding to it as well. Now we're partnering with different organizations. We run this program cheaper, essentially accelerators cheaper than anybody else. So we're trying to figure out how we can support large organizations to do that. And I think actually today it was announced we are running accelerator programs for the city of Glendale as well. They had a grant out there we just were able to accomplish, and so we're excited to expand not only just across the world, but here in Southern California too. This is my passion, so excited to talk about it with you all. And did I miss anything? I think you got it.
I think you nailed it.
All right.
Thank you for taking us through that. Maurice?
Yeah, hey everyone. Thank you for having me. I guess first and foremost, we have a fund called BAM Ventures here based in LA. We've been active for about 10, 11 years. We're on our 4th fund. Just to kind of hit the CRM fillers, we write 500K checks into the earliest stages of companies from pre-seed to seed. And we do consumer technology. So everything from your away suitcases, Allbirds sneakers, all the way to NerdWallet, HireGuide, to Scopely, to Honey. Before that, I was a founder, randomly happened to fall into medtech, worked on a product that basically helps opioid addiction, sold that close to 10 figures. Before that, I was a designer by trade, worked in automotive, worked at Ferrari, worked at Porsche, built Porsche's incubator, and that was kind of my roundabout way into venture. Like, what is this venture capital thing? You get to do multiple companies at once. Like, how fun is that?
Excellent. It sounds like the traditional paths to venture are not so much on this stage, which I think is a good thing for the most part. I know in the previous panel, we kind of talked about the LA ecosystem and more macro, so I wanted to dive into a little bit on the diligence side of things. I'm sure each of us have a little bit of a different process here, but looking at kind of when you guys go through diligence, what do you think are the most important aspects in relation to your stage that stand out, or that would be the most kind of indications of success?
All right, I'll jump in. As we have a few different evaluation periods, one into our pre-accelerator, the other into the fund. I think, from the perspective of the fund, we have the luxury of getting to know the founder and being under the hood with them, and that is easily the, knowing the founders. That's like what we're looking for. Like, that's the biggest thing. Are they going to be able to take it? Because we invest in pre-seed, right? There's such a long journey ahead, and can you see these founders making the steps they need to take? Are they able to, return to you having made the progress that you might expect of them? And in that, I think the easy, the more simple answer that we can also look for both of our evaluation periods are coachability. So those that are like willing to take advice and, obviously everybody's receiving a lot of advice, but choose the good advice, respond to it, and either explain why they're not doing something that you suggested because they figure something else, or that they think you're wrong. But being able to have a conversation and move forward. So I know not a typical answer, but coachability is one of the ones I love.
Something that's important to us is not chasing optical value and really looking for companies that have tied product, they're solving a product or a problem, that have product market fit, revenue, paying customers and clients. That's important to us. And then the other thing, just to build on kind of what you said, coachability, is we do a lot with what we call self-awareness in the due diligence process and how we tailor our questions and kind of analyze the feedback from the founders. We want to be able to obviously give advice. We want to work with the right partners, and we don't want people that just, do what we tell them to do, but we want to have that conversation. And we want to work with founders that don't believe they know everything, right? As a investor, I don't know everything. I don't know how to grow every type of business. I can admit that, and we want founders to admit that too. When they need help, we want to be able to help them. When we bring in trusted third parties, we want to be able to, make sure they're taking that advice, but not just acting on it. So self-awareness is another thing we look at as well.
Yeah, I think I doubled down on kind of that founder theme. For us, it's really very founder focused, right? Like ultimately ideas are dime in a dozen, right? There's so many ideas out there. It's execution. And I think around execution, it's more so resilience, right? Like you get beaten down, you just do it again. You get beaten down, you do it again. Like top of mind, right? Like we had a company last November. They're like, yeah, we're going to try like our last thing. If this doesn't work, like we've been doing it for 2 years, if we don't generate any meaningful revenue, we're just going to return capital, right? It's just not worth it. It's the slug of a kind of motion. And then that worked, and now they're doing about 2 million in revenue a week, right? And so from there to that in close to a year, I would say majority of founders would have given up earlier, right? They would have gone through 10 iterations and then given up. And it's like, maybe it's the 11th one, you never know how far you get. So I think in our process, it's really about the person. It's like, hey, who are you? We want to know like who your best friend is. We want to know, what's the biggest fight you've had with your parents and how you've overcome that. It's really about the founder. So
then kind of based on what both you guys had said, maybe more from a founder perspective, looking at advice, both, from investors, from everyone else that loves to give founders general opinions, kind of whether they're experts or not. How should a founder think about who to listen to and who to not listen to, when there's a world of noise? And maybe how do you guys think about delivering that advice?
I have this one top of mind because I just got an email where I'm going to have a really hard conversation with the founder on my way home. But I think the advice part is, I noticed at the beginning when I started, I gave a lot of advice up front to founders that I wasn't going to invest in or didn't invest in. And then it's like 6 months later, I get an email, oh my God, I executed on what you told me to do, like it's not working. I'm like, what do you mean? Like I just had a whim of a thought in a Zoom call, and like, I guess my word has much more power than what I thought it did, right? So it's like, I'm very much an investor hat in those meetings. I think advice should only come from stakeholders, right? Like if you have no stake in the business, it's very easy to tell someone like, oh, you should totally try this, and like, oh, do this and that. But if like you're not impacted by that decision, like it doesn't matter to you. So it's like being impacted and having a stakeholder. I'm a firm believer in like bringing on advisors that are helpful. I know it takes up a little bit of equity, but they're incentivized, right? And I'm all for that.
Surround yourself with people you trust. Obviously, people that have a stake in it want to do what's best for you and them, and take all different opinions. We all come from different backgrounds. People have grown different types of businesses, and then, digest that and do what's best for your company and what you think is going to help you grow and scale and get you to where you want to be.
Noise comes in a lot of forms and a lot of different phases. It's like, should you be focusing on this aspect of social media? And somebody's going to tell you who does that because they're in social media that that's the most important thing, or PR, or whatever. So I think it's also coming back to, I think something Petra said was focus on what your immediate goals are. Obviously focus on your customer, but think to your goals of what you're trying to achieve and what you're trying to get your company to, and help use that to kind of direct you and essentially turn out all the other noise that's out there. And from there, it's what they just said, the right people, and also know that even the right people can give you bad advice, unintentionally, or it's good advice. It just, there was some other information out there. We don't know everything. And so that's going back to going out there and working on it and being like, hey, this doesn't work, but don't wait 6 months to get back to somebody on that.
Pivoting back then to the diligence process, Marshall, you had mentioned revenue and or traction as kind of something that's very important when you're going through that process. Also, something that can outweigh a lot of red flags if there's significant traction. At the same time, probably something that founders like to get the most creative with when demonstrating that. I'd like to ask all you guys, what do you consider, what is traction, what is not traction, and how strongly do you view that when thinking about investing in a company?
Paying customers. We want to look at obviously revenue. We want to see paying customers that aren't your roommates, your family, your friends. We want to see that there's an actual real product and a market for it. There's willing customers to pay for your solution, and it's solving a problem that they have. And so we're looking at all that stuff. And there are investors that do seed, pre-seed. It's just not where we are. We don't really want to chase ideas. We want that business because we can help accelerate and grow it rather fast.
Yeah, I mean, traction does come in various forms. I think I love when founders do get creative with it in an accurate, effective way. Because you don't always have paying customers. You don't, it's awesome when you do. It makes it a lot easier for us. But partnerships, I think thinking about where the most impactful elements are, each of these little pieces of traction, there are a lot of forms of traction, even just team growth, right? Advisors, these are all just ideas of de-risking your business and helping us understand, with that, increasing the value of your business, all these little pieces. And so we do, being that we are one of the earliest steps in, support organizations in the kind of the funnel, we do have to, look at that and all those different pieces. And so I'm not going to discount any of them, but you're also not going to, you're looking at lines, not dots. I think as I'm sure all of you heard, that matters, right? So you really do need to dig in, and we have to dig into what they're trying to say. Try not to, if I was going to give advice to founders, try not to obfuscate what's actually happening there, because we're going to get to the bottom and that's just going to turn us off. Try and make our lives easier by giving us accurate, but show that those small little growth periods, and that's useful because we can see where you're going to go. And then when we talk to you again, in a month or whatnot, hopefully that's just a little bit bigger and a little bit, farther of a jump.
Yeah, I think on that note, we define traction more as momentum, right? It's great if you got 1,000 customers in a week. It's not so great if you did it in a year, right? And I think it's the momentum, and that's also how fundraising rounds happen, right? It's this they might be in, they might be in, they might be in. Okay, we're all just good, let's go, right? Instead of this maybe, dragging things out doesn't help anyone. And traction for us is defined in momentum. We invest earlier than most of the time. It's we have some traction, we have some revenue of our test pilot with some XYZ, but it's the momentum and the interest, right? So it's more of LOIs. It's the cadence at which things are happening. Ideally, from our first meeting to our check, it's a 3-week, 4-week process. In that, we've gotten 2 investor updates where you've doubled or tripled your inbound, or traction is happening at a high cadence.
I would say one thing I really like is stickiness. So if you can see that there's a very passionate user base that's really using your product, that's exciting to us.
Excellent. And then, alongside traction or revenue, we often hear a good team matters, especially at the early stage. What are you investing in? You're investing in a team. If any of you guys could kind of lean into that a little and define, what really makes a good team. Is that logos? Is that previous experience? I'd like to hear how each of you guys kind of define that.
I guess to start, right, we'd rather take a shitty product with a great team than vice versa. I think most people will, because your product's going to change, right? From iteration 1 to iteration X, it's just completely different. I guess it's harder to define what makes a great team, right? I think what doesn't make a great team is very homophilous teams, right? So homophilous is basically, for those that don't know, is the term that is used to define someone that are of like kind, right? So it's like you are all roommates and you all did your MBA and you're 3 co-founders. It's like, where do you share? Like, you all share the same skills, right? Ideally, it's like you went out of your network or out of your inner circle to find your co-founder that has a technical skill. You're a salesperson. You need a marketing person. So you build a team around different set of skills.
I mentioned it before, and I'll double down on the self-awareness. And it's, understanding and knowing that you don't necessarily know everything, taking advice, whether that's good or bad, and having the conversation and trying to grow the business off of that information is extremely important to us. Our first fund was health, wealth, and sustainability. So just pick on healthcare, worked with a lot of doctors, obviously brilliant people, working on some world-changing products, and they couldn't get out of their own way. They haven't scaled a business before. They haven't had to deal with HR issues or product issues, things like that. And so simple questions, are you willing to move over to be a CTO? And bring in a CEO that scaled a medical device company before, and seeing that response. And just one example is absolutely not. I'm the only person who can do this, and that was just a kind of a turnoff for us. And it was like, we wish you the best. We really want you to succeed, but you didn't even have that conversation. And even if it's just you're wrong, I want to know why I'm wrong, and I'm wrong often. So just having that conversation with the founders is important. And I think that makes for a good management team and a good founder.
I mean, it's a hard question, what makes a great team, but, or at least where to start. But I think 2 important traits are their chemistry and, their cohesiveness. Can they work together? I think his point of are they doing different things is really critical. You want to get as much of the business covered as possible, and also the different insights. And you pair that with a good chemistry, you've got a really powerful team just right there, ready to go. And especially if they have an understanding of their domain, however they achieve that, but really understanding their domain. And hopefully they're all interested in really becoming excited by that domain too, not just the CEO.
Have any of you guys made investments in a company where either the founder or the entire co-founding team doesn't have specific domain expertise?
So Brian, the founding partner of the fund, he founded LegalZoom on his company, Shoe Dazzle, and now he started a company called Arena Club. Apart from LegalZoom, where he was a trained attorney, on his company, right, diapers, he was not an expert in diapers after building LegalZoom. Shoe Dazzle with Kim Kardashian, he was definitely not an expert in buying and selling shoes. And again, now in Arena Club, right, he's not an expert in trading cards, right? And so I think it goes back to what I said earlier, the execution rights. It's and also to the founder, what makes a great team? It's there's a sense of obsession and it needs to happen, right? And it's I can execute, or I hire to replace myself. Right, so he's incredible at building teams, at building businesses, and I think it's a very different skill that is required to build a business than to be a technical person.
I would say if they didn't have expertise surrounding themselves with those experts, right? Having advisors, working with accelerators that have those type of advisors, fractional executives, third parties. There's always been someone there that has that expertise, and maybe the founder knows how to scale businesses, knows product, knows something like that, and the advisor is more on the medical side of things or fintech side of things. So surrounding yourself with those people is very important.
think anybody can become an expert in any industry. Just if you find a founder that's really passionate about it, and I've invested in companies with founders that were not originally in that space, and they became experts, and they've done amazingly well. But they were passionate, and they did the right things to learn it. And so, but by the time when I invested in them, I felt like they were experts in the field.
So kind of making sure that their why is sound as far as why they started that company, and or have the passion to do it for the next 5 to 7 years. Just to kind of zoom out now a bit, I know in the last panel there was some talk of secondaries, all of us being predominantly early stage, whether it's seed or A. IPOs is a little bit higher bar. M&A is a little bit tighter, potentially some changes coming there, but other than the one-off, either ultra high net worth person trying to, buy a stake in Uber or something like that, is there a way to actually have a secondaries market that becomes scalable and is actually a realistic option as far as liquidity for early stage investors, other than kind of just a one-off?
Two things have happened in the last 2-3 years. Call it market collapse, whatever you want to call it. There's been this crazy emergence of, call it a PE type secondary funds that have been growing, and mostly because funds still have to deploy capital. Funds still have to return capital in order to raise their next fund. So you have to understand the fund cycle. And so these funds are like, hey, can I buy your entire portfolio at a 50% discount? And at least you have DPI to then go and raise another fund, right? And so we've seen a lot of that secondary activity. And then other than that, if you're just looking for actual gains, we don't do secondaries because it's kind of, we're the friendly VC, we're with you till you die, and your business than we do, and you either hit a home run or you don't. And that's kind of our model. I think we're a little different in that because we have a much larger portfolio than most. So we live on that, some go to zero and some hit a home run.
And what is that signaling to your portfolio founders if you are selling off shares early or potentially?
Yeah, no one's gonna like it, right? It's
we're not against it, but it's more about the timeline, right? The longer it goes, we're trying to get in early, and so the returns can still be very, very high. And so we're not trying to just offload companies and use it for that purpose. It's more we're hitting our multiples, and hopefully, the fund will maybe at time. We're open to it. It's in our how we set up our fund. And I think things are changing too. The opportunities are there, but that's not our primary approach. So we're not against it. I also do think that the secondary market is good. I know funds that are, that's all they do, right? But yeah, they come in at, I think, B and exit at C, or come in A and exit at B. They're out, they're done. And it's a great model, and it works.
Yeah, I know funds that will have a clear strategy, which I think they're public about it. So it's FJ Labs based in New York. They'll take nearly every secondary and always sell 50%. That's just very simple. It's we'll take it out, and 50%, if it goes up, great, you save 50. If it goes down, great, you sold 50. 50 is kind of a nice number.
We don't do secondaries, but a lot of the due diligence process that we're looking at is companies that don't need multiple rounds of equity financing, maybe 1 or 2 rounds, maybe some debt, and then an acquisition from there, from a PE firm or a merger or so forth. So, a lot of the founders we work with are happy with a $200, $300 million exit. Our LPs would be happy. We would be all happy. So we're not necessarily chasing a home run on every bet. We don't necessarily need an IPO. We don't need a unicorn. We're looking for a number of doubles and triples and so forth, and just getting a solid return.
The cost of starting a business has gone drastically down. Productivity per employees has gone drastically up, or with the outlook of AI, should continue to go up. Does that leave kind of a great opportunity to continue in the early stage and potentially a later stage? Are there going to be enough companies to put very large fund allocations into, versus sitting in the early stage and a company only raises a seed or an A and they're able to grow from that point? what is the future? I guess the question would be, what does the future of later stage capital look like as far as getting into deals that may not need capital?
I think I somewhat disagree that it's gotten cheaper to start a business, because every service provider will charge you for something and employees are more expensive. And I think you're going to find a lot more like big founding teams, low equity founders that like, hey, I'm going to give you equity because we need someone to be an expert in this thing. I think funding rounds are going to be bigger and later, always. Like everything's going to be dragged out later. That's just because cost of doing business, for me, in my mind, has gone up a lot. Even though it seems easier to do a business, to actually be successful, I'll use CPG as an example. It's now cheaper to sell through Amazon than it is to go with ads direct to consumer. Right? And that used to be the other way. People were avoiding Amazon because it's predatory. They take 30%. It's like, oh, because your CAC through Instagram is 60%. Right? And so I think it's gone up doing business.
I think it really depends on the type of business, right? Sustainability, climate tech, some of these projects take billions of dollars to get off the ground, right? Software companies or software-based companies, maybe not so much, right? You don't need as much capital. You don't need as many employees to kind of grow and scale that business. So it's really dependent on the type of business and but it's probably shouldn't say this, but don't take venture money. I wouldn't recommend that. Try to bootstrap your company as far as you can go, and take on a strategic investor or someone that you trust, someone that you want to get to know and work with for a long period of time, or just keep trying to get it going on your own.
From doing proof of concept, I think that's probably a little bit cheaper and you can get some things done, which is great for startups to get going. If you're talking about building your own LLM, and having to run that and manage it, gets kind of a little bit more expensive. But yeah, I'm seeing that you can get a lot more done. It's just also bar is set higher across the board too, hopefully. Yeah, I'm excited for it. I think it's great for startups. I'm also a little bit fearful given, it's not the same era that we had back in, the big incumbents were not ready for the onset of technology of mobile and all of that. Now that they are for AI, and it's kind of a big bar to kind of jump over, and it's kind of a moving target. So I'm just coming from a startup perspective of but there's tons of opportunity to be had out there.
Awesome. Bar is still open downstairs. Appreciate everyone for coming out and have a great night.
Thank you.
Thank you.